I think we are entering a period of yield tranquility in the market. The big focus for us over the next 12, 24, maybe 36 months will be assets that are capable of delivering income growth.
So you've got to look at the regions for what they are, and manufacturing is important, and people almost forget that manufacturing does still take place in this country.
But investment is very simple. There's only two things that really matter. How many people want to occupy your property and how much property there is to occupy. What we try and do is identify where there are supply and demand imbalances, and that will drive our investment thesis over a long period of time.
I think there'll be less transacted this year. I think last year was pretty benign when you look back on it in terms of external factors and global factors. I think everybody's talking about the Brexit referendum. The risk of uncertainty will put a pause on activity, there's no doubt about it. And the other major event is obviously volatility in global equity markets. That damages investors' confidence.
I think it's down. I think but I don't see that as an owner of real estate. I don't see that as a negative. We're not in the transactional business. The more transactions we execute, the more fees we pay, and the more tax we give to the Chancellor. So slow down on that is not always a bad thing. It's much harder for owners to absorb the frictional costs of buying and selling, and therefore I just think you'll see more people sit on their hands and say, look, we've got this, we'll run it ourselves and we'll run it hard.
Well, property is one part of an investor spectrum of opportunity. And we can see in the wider economic indicators that there's been an element of cooling. We can see that inflation rates have been downgraded. We can see that there is trouble with the share markets. The FTSE and the Dow have been suffering. Investors are pausing to see if they can work out in which direction the market's going to go from here. At the start of the year, I think there was just a much more bullish attitude to investment, and I think people were very encouraged to get that money deployed early.
I think the investment universe might be a little bit cautious. We've got potential Brexit, we've got US elections which aren't too far away, we've got China, we've got oil. I think there's a bit of noise about that, and that might add to a bit of volatility. But underlying it all, I really believe in the economics of the UK market, and I think there will be a continued trend of investment into the UK. It is politically safe, it is economically very sound, the rule of law is good, and for every sovereign wealth fund that wants to recapitalise because of oil pricing, you have private individuals in other economies that want to divest out of those economies, and that's a broad depth of investors within London, and I think that will perpetuate. Maybe a little bit less than last year, but I think it's going to be another very strong year.
I think that the retail is going through a seismic shift. If you just look at nearly every trading statement that came out of retailers over Christmas, it suggested that physical retail sales were at best flat, and that all the growth came from their online businesses. And this is undoubtedly prompting nearly every retailer that we deal with to try and improve their omni-channel proposition to the consumer. So as a result of that, we have to therefore direct our real estate strategy in that way. We see retailer logistic opportunities benefiting from that structural change, and also increasingly focused around convenience food. We are a big believer in a migration to convenience food shopping at the expense of the traditional large supermarkets.
London's very, very strong, fundamentals good, sentiment maybe not quite so good, but inherent with that is opportunity for us. We believe in the underlying value of the real estate and the dynamics within that market, so we think there might be some more buying opportunity this year.
I think central London rental growth will continue. We're seeing a real boost to consumer spend through the reduced oil price, but I don't see that coming through in retail rental growth. I think the structural change in retailing is taking that money into different areas at a lower cost point. But I do see office rental growth in the regions as well, coupled with logistics. 40% of take-up in logistics is retail. So that the old mantra, sheds of the new shops, is absolutely something we believe in.
Well, we do see the interest. It is, I know it sounds like a bit of a stuck record. It is on logistics and employment opportunities associated with logistics. I think there's a realisation that
you know, massive spec office schemes in city centres is quite risky. Obviously, everyone dreams for the pre-let. What we tended to see, I think, is single buildings. That's where it is.